Welcome to our podcast, where we dive into the fascinating realm of portfolio management. It's basically the secret sauce behind effective investing.
I'm really excited about this, especially because managing investments effectively can really change your financial future.
Right. So, portfolio management is all about selecting, overseeing, and adjusting a mix of investments, stocks, bonds, mutual funds, even alternative assets to match your financial goals. It's like
Yeah,
curating a collection that balances risk and potential returns.
and that's key, right? You need to balance risk and reward carefully.
Exactly. It's about creating a strategy that not only aims to maximize returns but also minimizes risk. It's, a bit like constructing a delicious recipe where each ingredient has its own role.
Absolutely. And one of the core elements they mention is asset allocation, right? How do you see that playing into the bigger picture?
Yes, asset allocation is deciding how to divide your investments among different buckets: equities, fixed income, real estate, etc. By properly allocating
Right.
assets, you can tailor your portfolio to match your personal risk tolerance and financial objectives.
So it's kind of like having a diverse pantry at home. If one ingredient goes bad, you still have plenty of options, right?
Precisely. And that brings us to diversification. Spreading your investments across various sectors or asset classes helps reduce your risk exposure.
Yep.
If the tech sector takes a hit, your bonds or real estate might keep you from a total loss.
Yeah, but don't you think sometimes too much diversification can dilute potential gains?
That's a fair point. It's like having too many cooks in the kitchen. They might dilute your flavor. The trick is to find the right balance so you're not overly concentrated in one area but not spread too thin either.
Interesting balance indeed. Now, portfolio management isn't static, right? There's this concept of rebalancing. Tell me more about that.
Right. Rebalancing is about periodically tweaking your portfolio so that it stays aligned with your initial
Exactly.
asset allocation. Imagine if market movements shift your mix. Rebalancing helps you get back on track, like adjusting your sails when the wind changes direction.
That's a solid analogy. And then there's risk management. How do you see that playing into effective portfolio management?
Risk management is the practice of understanding your own risk tolerance and setting up strategies, like hedging or stop loss orders, to protect your
Absolutely.
investments. It's really about preparing for the storm when market volatility hits.
True, protection in uncertain times is crucial. And for beginners, the idea of risk management can be daunting, right?
Yes, totally. Beginners often get overwhelmed thinking about every little market dip. But understanding your own limits and having safeguards makes the whole process much more manageable.
It's like having a safety net at a trapeze act. You know, that extra layer of security helps you take bigger leaps.
Exactly. It's all about keeping yourself within a risk zone that you're comfortable with. And aside from that, knowing why portfolio management is so crucial is fundamental.
Yep. Yeah, well-managed portfolios can really maximize returns and at the same time help you avoid serious pitfalls, right?
Absolutely. By aligning your investments with clear financial goals, whether that's short-term gains, long-term wealth building, or setting aside funds for retirement, you're setting yourself up for success.
Right.
The approach adapts as market conditions change, ensuring that your strategy remains on track.
Now, I find the active versus passive management debate quite intriguing. Which approach do you feel works best?
Oh, good question. Active management involves more frequent buying and selling, requiring research and quick decision making.
Yeah,
On
I
the
get
other
that.
hand, passive management is more hands-off, like investing in low-cost index funds that mirror market indices such as the S&P 500.
So, active is like being a chef who experiments daily, while passive is more like sticking to a well-tested recipe.
That's a neat analogy. And honestly, both have their merits. Active management might promise higher returns, but it's also more time-consuming and risk-laden.
True.
Meanwhile, passive management provides a more steady, reliable approach over the long term.
But don't you think some investors might be tempted by active management, despite the risks?
Sure, many are enticed by the idea of beating the market. Yet, the research often shows that over time, passive strategies usually win out for most investors due to lower fees and less emotional trading.
I see your point. Interesting. It's almost like playing a game where the house always wins unless you're extra careful in active plays.
Exactly. And for beginners especially, the learning curve can be steep if you dive into active management without deep knowledge. That's why it's important to educate yourself and even seek expert guidance when necessary.
Absolutely. Speaking of education, the idea of leveraging tools and AI mentors from platforms like Investling really sounds modern and forward-thinking.
Definitely. Investling's approach is all about providing accessible, AI-powered courses that simplify the seemingly complex world of portfolio management.
Yeah, right.
Through interactive lessons and practical exercises, anyone can start building a diversified portfolio that fits their personal goals.
And that personal touch is essential. Everyone's financial journey is unique, right?
Exactly. Whether you're saving for a home, your child's education, or your golden years, a well-constructed portfolio keeps you on track.
Absolutely. So it really boils down to knowing yourself, your risk tolerance, your goals, and using that insight to make informed decisions.
Yes, it's like tailoring a suit. You need to know your measurements to get that perfect fit. And that's what smart portfolio management is all about.
One thing, though, what about the critique that sometimes these strategies can be too rigid in dynamic markets?
That's a valid point. While the principles of diversification and rebalancing are solid, markets do have unpredictable elements. It's essential to remain flexible and, periodically reassess your strategies to ensure they're still suitable, rather than sticking doggedly to a plan that's no longer optimal.
So, continuous learning and adaptation are key. It's a blend of strategy and real-time adjustments.
Absolutely. And that's why investing in your financial education, like taking those courses and staying updated on market trends, is so important.
Right. It just goes to show there's no one-size-fits-all when it comes to portfolio management. But having a solid foundation definitely gives you a leg up.
Precisely. It's about building a strategy that evolves with you as an investor. You start with a clear understanding of your goals, assess your risk tolerance, and then, through active or passive methods, strategically move your money. And always remember, this isn't financial advice, but more of educational guidance to empower your investing decisions.
Perfect summary there. I think our listeners will definitely be inspired to explore portfolio management further and perhaps even check out some of these AI-powered courses.
Absolutely. Start small, keep learning, and let your investments work for you. Thanks for joining me in this deep dive into portfolio management today.
Thanks for the insights. It's been really enlightening.